Global markets have been firmly defined by a continuation and, in some cases, an acceleration of the risk on narrative, with geopolitical de escalation in the Middle East acting as the dominant macro driver. Optimism around a potential US Iran agreement, alongside indications that shipping flows through the Strait of Hormuz may normalize, has driven a sharp repricing lower in oil, easing inflation fears and pulling global bond yields down. This has removed a key overhang for risk assets and reduced pressure on central banks to maintain an aggressively hawkish stance. In FX, this has translated into broad-based US dollar weakness, with the greenback under sustained pressure as lower yields and fading safe haven demand combine. High beta currencies such as the Australian dollar and New Zealand dollar have remained well supported near recent highs, buoyed by the improvement in global sentiment, while the Chinese yuan has strengthened to multi-year highs on a firm policy backdrop and improved external conditions. The euro is trading with a constructive bias, largely as a function of the weaker dollar rather than domestic strength, while the Japanese yen remains more nuanced, holding firmer on the back of intervention and lower yields, but still facing structural headwinds from carry dynamics and energy exposure. On the equity side, global markets have pushed higher with strong gains across Asia, most notably a sharp catch-up rally in Japanese equities to fresh record highs, feeding into continued resilience in U.S. equity futures, which are consolidating near record highs. The combination of lower yields, easing geopolitical risks, and supportive earnings momentum, particularly in tech, has reinforced the bullish tone. Commodities reflect the same shift in narrative. Oil has continued to cool as the geopolitical risk premium unwinds, while gold remains elevated, supported by the weaker dollar, even as risk appetite improves. From a macro and policy perspective, the ease in oil is critical as it directly impacts inflation expectations and central bank reaction functions globally, from the Federal Reserve to commodity-linked economies. That said, policymakers remain cautious, with several central banks highlighting that inflation risks have not fully disappeared, particularly if energy dynamics shift again. Looking ahead, the focus now turns to key U.S. labor market data, with initial jobless claims due later today and the non-farm payrolls report on Friday standing out as the week's key event risk. These releases will be critical in shaping expectation around the U.S. growth outlook and the path of Fed policy, particularly in the context of easing inflation pressures. In Europe, attention will remain on trade developments and central bank commentary, while globally, markets will continue to take their cue from geopolitical headlines. The broader takeaway is that markets are increasingly pricing a more benign macro outcome, but with positioning now leaning more constructive, the bar for further upside may depend on confirmation from incoming data and continued geopolitical stability. That's all for now.